Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to required new fund formula to calculate the estimated new funds that will be needed for the expansion of the company in the future period. This will be similar to a prior presentation, although there will be adjustments to the calculation based on some different assumptions, including that the current assets and liabilities change relative to sales. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheets on the right-hand side, focusing in on this formula. We're going to be breaking this formula out into its components as we populate the worksheet down below. So let's take a look at our information on the left first. We have the expected increase in sales. We're going to think that the sales are going to increase by 40%. The assets, the fixed assets are going to remain the same. So we're not going to increase the fixed assets related to the increase in the sales. This time, this is going to be different than a prior practice problem we looked at where we assumed that the fixed assets would have to be increasing in order to generate an increase in sale. We have the current liabilities will vary with the sales change. So in other words, the current liabilities will vary as there's going to be a change in the sales, but not the long-term liabilities. All right, so then we have our income statement information. So this is going to be the income statement for the current period, not the projected income into the future. Then we have the balance sheet for the current period that has passed, not the projected period into the future. We want to use the percentage of sales method to see if external financing is needed. So we want to project out into the future and see if we need more financing given the fact that we have this expected increase in sales of the 40%. To do that, we're going to use this formula. You can break this formula out into basically its components, mirroring basically the accounting equation here, assets equal liabilities plus equity. If we figure out how much we think the assets are going to increase, in other words, then we have to finance that increase either with the liabilities and equity. And if we think there's going to be an expected increase in sales of the 40%, if we use the logic of a return on investment or total asset turnover type of calculation, you would think that the assets would have to increase in order to support the increase there. We're gonna assume, however, here that the increase in the assets that are going to be changing will not be the fixed assets. We're going to say the fixed assets are going to remain the same, and we're gonna make the adjustment not including basically the fixed asset for this calculation. So we're kind of varying this formula here to suit the needs that we think are most applicable in any given situation. So the first part of this equation, then you could see right here, we're going to think about that as kind of like the asset part of the equation, the increase in basically the assets proportion to sale, minus kind of like the liability portion of the equation. And that's going to be, if this portion is the asset portion minus the liability and the equity, which are the two portions that will support the increase in assets, right? So if assets go up, they have to be supported by these two items or additional financing may be needed. So this will be the increase in the liability portion, which again, we're not using total liabilities, however, because we're saying only the current liabilities will change. And then we have the equity portion, which will basically be calculation of the change in equity, which is basically net income increasing minus the amount of the dividends that we gave out. That would be the change in equity. So assets go up, supported by the increase in liabilities and supported by the increase in equity, meaning net income minus anything we gave back to the owners in the form of dividends. All right, to do this, we're going to need the profit margin percent. So let's calculate that first. We're going to say, let's take a look at the earnings after taxes, or the net income. The net income, this is in the prior year that has passed already, not in the projected year in the future. We've got the sales. Then the sales is going to be the top line. This is just our profit margin calculation. And that's going to give us our profit margin, which will be equal to the net income or earnings after taxes divided by the sales. Let's make that a percent by going to the Home tab, Numbers group, percentifying it. And you might have some decimals here. I'll bring it out a few. Notice it's not even, so it's about 15.66. When we use that in order to do our calculations, it's going to use the actual number here, but note that we do have rounding involved. That's just the way of life for normal business calculations when we do these projections to deal with rounding. Home tab, Numbers group, let's go Home tab, Font group, and underline now. Now we want to think about the payout ratio, which is another calculation that we will need. We haven't seen this as much in the past, but we're basically just thinking about the earnings that we have, how much do we expect to be paying out in the form of dividends. So to do that, we could say, okay, well, how much did we pay out in dividends last time? We paid dividends out of this 12,180, and we're going to compare that to the earnings after taxes and say how much of those earnings did we pay out in terms of dividends. And that's going to give us our payout ratio, which is going to be the dividends divided by the earnings after taxes. And so let's make that a percent. Let's go to the home tab, numbers, percentify it, and then we can add some decimals. Again, it's not perfectly, we're going to round it to 2 decimals. So in other words, if we think about the net income and multiply it times this percent, that will give us the number of dividends that we paid out of the earnings to the owners. So we're going to use that same percent in our calculation to assume we're going to pay out the same percent basically to the owners of whatever net income is in the following year. Okay, so now we're going to think about our equation. We got what we need in order to populate our equation. We're going to think about this in 3 parts. Once again, I'm going to do this in like a tax format. We're going to pull this apart into a vertical type of format. I think that'll be easier to kind of see if we break it out in this format. Obviously, you could put the numbers in an algebraic format in this way and work it out algebraically as well. I would recommend doing both methods. I think it's really useful to kind of break it out in a vertical kind of tax form type of calculation here. We're going to start with the assets, but note we're going to modify this and really just pick up the current assets because those are the ones we think are going to change relative to the change in sales. So I'm picking up current assets instead of total assets here. And this is one of the assumptions we're making within our calculation to adjust it. We're not going to be adjusting the fixed assets. The fixed assets aren't going to change, we're saying, with relation to the sales. And then we're going to compare that to the sales line, which is the top line of the income statement. We're going to say this equals the sales. Now this is going to be a subtotal. I'm going to pull it out over here. I'm not going to name it. This will just be the ratio. So we'll take the current assets over the sales. Let's add some decimals here. Let's go to the home tab. Numbers, let's actually make it a percent. We could see percent and some decimals so that we can get a few more decimals in there. So 49.15, and then we want to think about the change in the sales, which is this component of the formula. The change in the sales, let's put a little subtotal here. So we're going to say, all right, the sales for year 2. So let's just type in sales for year 2, or the projected sales are going to be equal to the prior year sales top line number, and then they're going to increase by 40%. So I want to use this number up top. I want to multiply times 140%, which will keep the original number plus the 40% increase. So I'm going to say times brackets 1 plus the 40%, or 140%. Close up the brackets. Okay, so that's going to be the increase, and then we got the sales for year 1, which are simply going to be the sales that we have here. And that's going to be the change in sales. And I'll pull that into the middle column. So the difference is going to be the 413 minus the 295. That's going to be our change. Let's put an underline here. Home tab font group underline. Let's put an underline here. Home tab font group underline. Then I'm going to pull this into the outer column, just multiplying these 2 cells out. This will then be equal to the 49.15 times the 118, and that's going to give us our change. So this is kind of like the increase in assets component that we have. So this is like the assets component of our formula that we are considering. You can see how we basically took that. We said, look, this is going to be the ratio of the current assets to the sales, and we think that if we want to make anything over basically the sales number of the current year, then we're going to have it changed in the current assets relative to that increase. That means we're going to need an increase in assets of the 58 million. And then we're going to need financing that either with liabilities or equity. So now we're going to compare that to the liabilities and the equity. So let's go on down to the liabilities. Now the liabilities, we're going to, once again, moving here, but we're going to say only the current liabilities are varying with relation to the number here. So we're going to be picking up the current liabilities. and we'll pull that into the inner column. So we're going to say the current liabilities are going to be this item. We're going to be comparing that once again to the sales, because we're going to say it's going to change relative to the sales number. So sales, and we could say sales for year one. So sales for year one might be a more appropriate label. And then we'll underline that. We'll go to the Home tab, Font Group, and underline. We're going to put the calculation here, the ratio, current liabilities over the sales number. Let's make that a percent so we can see some more items. So we're going to make that a percent, and then I'm going to add some decimals. So again, you can keep going. It's rounded. We'll have to deal with rounding all the time. So we got that rounded number there. Now we're going to compare that to the change in sales, which we already calculated up top. That's going to be this item. And so I'm just going to pick up the same number, the 118. And notice I could format this one up here. It has a colon. So let's go ahead and format this, selecting these three cells. Home tab, alignment, increase the indenting. Then this one, Home tab, alignment, increase the indenting. And that'll give us our little subcategory that we have. Change in sales, we'll pull this out to the outer column now. We're going to say this is going to be equal to this number times the change in sales. So we think the liabilities then are going to increase by the 12,801. So once again, we're comparing only the current liabilities that we think are going to increase relative to sales. And so we're going to use that same percent, that same ratio, multiplied times the change or increase in the sales. We think the liabilities will increase by that amount. That'll help us to finance the increase in then the assets. Now we're on the equity side of things. So for the equity side of things, let's go ahead and underline this number too. Let's underline here. Home tab, font, underline. Let's underline here, Home tab, font, underline. Okay, so now we're on the equity side of things. So we're going to have the profit margin. So we'll pick up the profit margin, and that's going to be then, and I'll put this in the middle column, equal to, and we're going to say we calculated that up here. So profit margin, and then I'm going to say Home tab, numbers. Let's make that a percent, add some decimals. Again, we could keep on going. It's going to be rounded. So notice if I just typed in the number, it would be rounded. It wouldn't be the exact number. Pulling it from that cell gives it, basically the exact number. Then we have the sales for year two that we calculated up top. We're going to say sales for year two are this 413. Now note, I'm just going to do a side calculation over here so we could see what's going on here. Side calculation. If we took then the multiplied these out, the sales that we're projecting times the profit margin, we would get basically net income, which is an increase in the equity section. But we're going to pay some of those out in dividends. So we want to have the calculation of 1 minus the dividend percent. 1 minus the dividend percent. So what does that mean? Notice that we're basically saying this. If the dividend percent, we're going to assume based on the year that has passed. So we had dividends here divided by the earnings. So that means if I was to make that a percent, Home tab numbers, make it a percent, it's going to be 26 point something percent, right? So if I take that number and say, okay, then I think that in the following year, our net income now, we now decided that our net income is going to be this number. So the amount of dividends that we're going to have then, if we use the same percent that we're going to have dividends, that's going to be this times this number. And so that's the amount of dividends we would have. If I subtract them out, the net increase in equity would be this minus this. That would be the net increase in equity. So we're using this percent to figure out how much of the dividends we're going to pay out. So I'm going to underline this. Now, if I use that in a nice clean formula, I can say, well, these two represent the amount of income. If I multiply those out, that's the amount of income that we're going to have, net income to increase. And then I want to calculate how much of that income we're going to keep, not how much we're going to pay out like we did here. So then I'm just going to say 1 minus, basically this ratio. So let's use this instead of picking up this number in I-24, I'm going to say brackets, and I'm going to say this number, the dividends divided by this number. So you can see that calculation when you look at this worksheet, and then I can delete this calculation. And so here we're going to multiply the three numbers. So what I want then is 1 minus the percent we're going to pay out, because that's the percent we're going to keep. So we can calculate that as, and we could use the, we actually calculated it up top here, right? So I could say we need 1 minus, and I can pick up this ratio we used. And so there we have it. And then I can go to the home tab, numbers group, percent, and we can make it a little bit larger so we have some more data there. I can underline that. Let's put an underline up top here. Home tab, font, underline up there. Okay, so I think we're okay on the formatting. So then I'm going to multiply these out. This equals the profit margin times the sales times the amount that we're going to keep that we're not going to give out in dividends. And that's going to give us the 47,614, which you can think about as this way. This is the equity portion. You can think about equity is going to go up by net income minus the dividends that we pay would give us the net increase in equity, right? So you can calculate it 2 ways. So this is a little bit more streamlined, fits nicely into like a formula up top. So what we have here then is we've got the amount of assets we're going to increase. We're going to finance that asset increase either with liabilities that we think are going to go up because they're going to go up relative, and then the net increase in equity, income going up, which is also going to finance the increase in assets, income going up, minus the amount that we expect to pay out in dividends. So are any new funds needed? Funds needed is going to be equal to the assets that are going to be increasing minus the liabilities to finance them minus the equity to finance them. And that would mean that we don't need funds at this point in time because we came out with a negative fund number. So funds needed, or we could say excess funds. So let's put an underline here. I'm going to put an underline here. We'll put a double underline here. And so there we have it. So the assets are going to go up, and we have more funds than needed in order to fund that increase in assets.